Good morning, everyone. Thank you for joining us and welcome to our first 2025 Canadian Market Outlook webinar focused on capital markets and everything commercial real estate. My name is Mitch Blaine. I'm an Executive Vice President at JLL based here in Southwestern Ontario, and I'll be your host for today's discussion. We're thrilled to have you join us as we explore some of the latest trends, challenges, and some of the opportunities we see shaping the real estate landscape in Southern Ontario and beyond as we clearly navigate this evolving economic environment. We feel understanding the macro forces at play, capital markets, and sector-specific performance is critical. Today, we're going to dive into, obviously, the broader economic landscape, GDP, growth trends, employment data, interest rates, inflation, and everything macro. We're also going to touch on, obviously, some of the trade and geopolitical factors, some of the implications that may have for commercial real estate in the U.S. and Canada. We're going to take a time to do a broad overview of the capital markets outlook and investment trends we anticipate in the short and long term, bond yields, and where we see pricing and transaction activity headed. And then we're also going to dive into specific sectors of office and industrial real estate, things along the lines of vacancy trends, leasing activity, and general investment performance. To guide us through these various topics, we've got an outstanding panel of experts, including Scott Figler, who leads Canadian research for our JLL team. We've got Matt Pickin, Executive Vice President, and leads our capital markets team across Canada, and Chris Kotzeff, Executive Vice President, who will give us a lot of insights into the office leasing market in Southwestern Ontario. Obviously, share a lot of insights, forecasting, but all of it backed by data and real trends that we're seeing in the market today and what we anticipate in the future. Just before we get started, a few housekeeping notes to touch on. Webinar is going to run for about 60 minutes. At the end, we will leave time for Q&A. For those that want to stick around beyond the hour and participate in some of the Q&A, by all means, please do. Please submit your questions through the chat, and we'll be sure to do our best to get to them. And additionally, if you have any technical difficulties, feel free to use the chat as well, and we'll do our best to support and assist you with any technical difficulties. So with that all said, trying to be prompt, as I know there's a lot being done right now. We'll dive right in. Kick things off. I'm going to hand it over to our head of research here in Canada, Mr. Scott Figler, to walk us through the macroeconomic landscape. Scott, the mic is yours.
Thanks, Mitch. Thanks for having me. Good morning, everybody. It's an interesting time for sure. We just finished off a lot of our research on what happened in 2024, what we think are the big trends to look at in 2025. And I think this is probably one of the most anticipated, sort of outlook refreshers that we've had, certainly in my experience over the last few years. There's just so much going on. It's so fluid. And so we're going to go through some of what we're seeing. I'm going to start with just some kind of broader trends in the economy, in the world that we're looking at. I think the theme for 2025 is uncertainty. I wish there were a better word to describe it. I think there's a lot of good things in the works for this year, and we'll get to those. There's a lot of positives, but there's just a lot of uncertainty. You look at the geopolitical landscape. Trump is with Putin right now negotiating about the future of Ukraine, what that means for Europe, deglobalization, pulling back from China, reorienting of supply chains. We'll talk a little bit about what that means for Southwestern Ontario, obviously a critical supply chain node in North America, the Middle East, what's going to happen there, and then obviously, the U.S. administration and some of the sort of imperialistic, comments they've made and claims. So we'll see how much of that is real and how much is not. U.S.-Canada relations. This is obviously top of mind. What do these tariffs mean? How long are they going to last? What what and where are they going to hit and how hard. Obviously, the Kendrick Lamar and Drake saga just continues to um, put a cloud over everything. And then obviously in Canada, we have our own federal and provincial elections coming up that are going to, impact markets. So I guess we'll start off just broad picture, what's going on in the economy. This is going back to 2007, real GDP growth and per capita GDP growth, per capita in this gray. And you can see over the last few years, the Canadian economy has slowed kind of in 3 consecutive years now, kind of losing steam after bursting out of the gate after COVID. Um, these blue bars representing real GDP growth, which takes into account inflation. But then you see in gray here per capita. So obviously, what's going on here is that the economy is kind of treading water in real terms, 1.3% growth down from 1.5 last year, but even in real terms, down from the historic average of 1.6% annual growth. So we're underperforming. But then when you consider population growth, looking at GDP per capita, the Canadian economy has actually shrunk 3% cumulatively over the last 2 years, 1.5 this year and negative 1.5 last year. So 3% over the last 2 years, the economy on a per capita basis has basically not kept up with population growth. Forecasts for 2025, full disclosure, these forecasts do not take into account tariffs because it's impossible to forecast right now the trajectory of tariffs. But this is the latest from the IMF. And I think it resonates with where a lot of us were thinking back in November, where there's a lot of optimism and enthusiasm about 2025 and what it would bring. If tariffs end up being a negotiating tactic, if they're revoked, soon-ish, I think we're going to be in store for, a year that's going to be much better than last year in terms of private sector activity. But it's just impossible to say. But just as a reference point, this is kind of what we were looking at as a status quo before all the tariff news hit. And then when you look at the labor market, it sort of reinforces this, a lot of what we just saw. So these blue bars here are job growth, monthly job growth, how many jobs are added to the economy. And you can see 2021 coming out of the pandemic, we were all sort of playing catch up. The economy was on fire. You had 250,000 jobs added per month, and then it slowed. But the last 3 months here, since November, have actually been the best 3-month period of job creation since going back to late 2022. So again, you put yourself back in the mindset of November before a lot of this stuff happened, and it makes sense. Like there's a lot of optimism, there's a lot of private sector investment happening. Unemployment rate fell from 6.9 to 6.7%, and over 200,000 jobs created. So that and it's to be expected when you think about what happened with interest rates, right? So interest rates fall beginning in middle of last year. We started at 5%, the overnight lending rate, policy rate, benchmark rate, and then all these rate cuts down to 3%. Obviously, the thinking behind that is inflation is behind us. It's time to stimulate the economy and ramp things up. And so we saw that translating into job growth. We saw it translating into private sector investment towards the back half of 2024. Now, the other thing that this chart is showing is forecasts for future policy rate cuts, right? So, and this just shows at different periods of time. So this is back in October, November of last year. You can see investors were betting on the policy rate sort of stabilizing at 3%. And then with every additional rate cut, you see the market adjusting. And now where we are, the policy rate at 3%, the private sector is sort of pricing in policy rate cuts that are sort of stabilizing just north of 2.5% over the next year and a half, call it. So, or even 2 years. So we get asked all the time, what's the outlook for interest rates? Well, this is our best answer, is how markets are pricing in the Bank of Canada policy rate. Um, right now we're at 3%. We might have another one or two cuts of 25 basis points ahead of us, but there's obviously a lot that depends on, right? Um, if if we start to see a rebound in inflation, if tariffs lead to um, a bump in import prices, that could create inflation, and then the Bank of Canada would put a pause on further interest rate cuts. So it just depends. But this is kind of where we are right now and where the market is forecasting interest rates moving forward. The good news is that inflation seems to be behind us, at least for the time being. This thick black line here, this is the one that is the most important for Bank of Canada. This is the CPI, what they call the core CPI. It strips out food and energy prices, which tend to be more volatile. Okay, so a small uptick over the last reading, but we're still comfortably within the Bank of Canada's target range, 1 to 3%. These other lines here are different components within the CPI. So this green line here that you see hovering above, this is shelter costs. Obviously, we know we're in a housing crunch pretty much across Canada. We're going to talk a little bit about that in the next slide. Shelter costs continue to be above the rest of the CPI, now at 4.5% year over year price growth. But you look at where we came from just 6 months ago, where we were at shelter costs were pushing 8% year over year price growth. So again, we've made a lot of progress on this. It's emboldened the Bank of Canada to drop interest rates. But one thing that I would say we're looking at very studiously right now is the U.S. inflation rate. And I think a lot of the Bank of Canada policy over the next few months, it's going to obviously take into account what's happening in the Canadian economy, but I would say it's just as important what's happening in the U.S. economy. If you've seen the news, the January inflation reading in the U.S. was way ahead of expectations. It was 3%. So in the U.S., they're pushing that target range, and that's before the impact of tariffs. So if in the U.S. we start to see an uptick in inflation, that means that the Federal Reserve is not going to cut interest rates in the U.S. And if the Federal Reserve is not going to cut interest rates, then the Bank of Canada will probably be a lot more reluctant to cut interest rates, because the more of a gap there is between interest rates in the U.S. and interest rates in Canada, the more capital is going to flow to the U.S., and that's going to devalue the Canadian currency. So again, Canadian inflation well within the target range, but we also need to keep an eye on U.S. inflation. So we look a lot at demographic shifts that are happening around Canada, because it's one of the best leading indicators for how different sectors of the economy, different sectors of the real estate market are performing. And for me, it all this sort of sums up what's going on when you look at demographic momentum around Canada. There's a few markets that are extremely expensive right now for housing affordability. Obviously, Vancouver and Toronto. And then at the end of the spectrum, you see these prairie markets that are a lot more affordable. And what this is measuring is the housing price to gross income ratio. So I use here in the commentary, I use the example of Edmonton. The average household income in Edmonton is $103,000 a year. Benchmark home price is $397,000 a year. So the price to gross income ratio in Edmonton is 3.9, just as an example. All right. The most affordable market right now in Canada is Regina. Least affordable is Vancouver. So this is not to say that we're not seeing a lot of activity in Vancouver and Toronto. It's quite it's the contrary. Those are the biggest investment markets, continue to be. But if you look at where population growth is happening in Canada, you see these cities that have a lower price, a lower housing price to gross income ratio. So Waterloo region, was, kind of middle of the pack there. But what matters, of course, and those of you in Southwestern Ontario know this, it's about how Waterloo Region compares to Toronto. So if the PGI ratio in Toronto is 10.7, housing affordability has been very tough there. Then you start looking at places like Niagara Region, Barrie, Waterloo. And so not surprisingly, some of the fastest growing cities um, in Canada over the past 2 years have been Barrie, Oshawa, London, and then number one, congratulations, Chris and Mitch, Waterloo Region for the last 2 years has been the fastest growing city in Canada. I think when the 2024 numbers come out, it's going to change. I think Calgary is going to be number one, but this just gives you an idea of where we're at. So the fastest growing cities in Canada you can basically put them into three buckets generally. You have your Toronto spillover cities, so Waterloo, Barrie, London, but then you have your Atlantic Canada cities. Look at Moncton, very fast growing city, tiny market, obviously, but a fast growing city. Halifax, and then you have Western Canadian markets: Calgary, Saskatoon, Edmonton, Regina, and Vancouver. So this is more of a story about multifamily markets where we're seeing multifamily investment volumes picking up. It's a story about retail sales. Again, not to say that there isn't a lot of opportunity to be had in those core markets. It's just that we're seeing a bit of a shift demographically, and it's coming through in some of the metrics that we're tracking. And the last big thing that I would mention on the economy and on demographics is the change in immigration policy, and this is going to have important implications for Southwestern Ontario. So you can see over the last few years, total net immigration gains have kind of trended between 400 to 600,000 down in 2021, and then you see it just skyrocket over the last 3 years. A lot of this is due to this light blue here, which is non-permanent residency. So this is temporary work visas, student visas, which sort of exploded after the pandemic, leading to a 3% annual population growth rate for Canada in 2024. So, this with other factors has sort of contributed to kind of what we've seen sort of strains and pressures on, whether it's, hospitals, healthcare systems, housing, infrastructure. This population growth has, um, it's had a lot of good implications. It's been certainly helpful for retail markets. It's been helpful for multifamily markets. Um, but the flip side of that is that it's also, contributed to some shortages in these areas. And so the IRCC is pulling back on immigration, and how they're doing that is by it's the bulk of it is pulling a 180 on non-permanent residents. So this light blue that was pushing 800,000 new NPRs in 2024, the plan over the next 2 years is to have a reverse flow of around 900,000 non-permanent residents. Now, a lot of these people will move into the permanent residency pool, and they'll just absorb this 400,000, 350,000 per year of permanent residents. A lot of those are going to be the existing non-permanent residents that just apply for permanent residency. But there will be several 100,000 people that the government of Canada presumably is going to essentially send back home. Now, there's whether they're going to enforce that. I think there's questions to be had there. It's not easy to do, certainly politically or logistically. It's a tough thing to do. But this is the government's plan to kind of pull back population growth. So I want to just turn it over to Chris and Mitch on this, because this has very important implications for in a variety of ways. I'll start with Chris. Universities in Southwestern Ontario, what are they saying about this policy, how it's going to impact them?
Yeah, without a doubt, for the last couple of years, Scott, like you said, we've seen a huge run up of activity from the post-secondary institutions, both acquiring buildings to, office buildings to convert to classroom space, leasing space, conventional office space to take that to classroom space, and also housing. In addition to that, to support all of the student immigration that they were seeing. But with the shift and pivot in policy, that's virtually dried up. We're not seeing, since that came into play, we really aren't seeing very many of the schools take on additional space or even considering buying buildings and looking at doing that.
Yeah, and from a bit more of a labor pool standpoint, I would say it's no doubt going to have some effect. We've obviously had a skilled labor shortage in Canada for quite some time. I think a lot of the resiliency in Southwestern Ontario has been because of the post-secondary institutions that have allowed a lot of the labor pool to reskill in downturns. I mean, Waterloo, with some of its technology clusters, really create some interesting innovation spin-offs. But even just, I appreciate there's a lot of narrative about mass producing, reshoring, everything we hear out of the US in particular. I mean, when you look at a place like Southern Ontario, especially around Waterloo region, Wellington region, there's that real high quality, high IQ type of manufacturing, advanced manufacturing, if you want to table it that this may have an impact on as well, and our ability to have capacity to really meet the needs of our own reshoring efforts here. So there's going to be some knock-on effects, no doubt, in the labor pool as well.
Makes sense. So I'm going to move on to I think what everyone's talking about right now, which is the trade war and some of the implications for this. So this is essentially the issue here. The way that the U.S. administration is thinking about this is they're trying to amend a trade deficit that's about $1 trillion. So you have imports totaling, call it 3 trillion, exports totaling 2 trillion, and they're trying to amend that and redirect investment and capital flows and job creation into the U.S. So the thinking is that by raising tariffs, they're going to accomplish two things. The first is that companies exporting goods into the U.S. will partially absorb that tariff cost instead of passing it on to consumers. I just listened to an interview yesterday with Peter Navarro, who is the Trump tariff czar, you can call him, kind of the architect of this policy. He thinks that it's the New York Times daily podcast. If anyone listens to that, it was yesterday's episode. He thinks that if you tariff Chinese goods into the U.S., that Chinese producers are going to absorb some of that because they don't want to lose market share. They want to keep servicing U.S. Consumer bases. And so he doesn't think that the full 25% tariff, for example, is going to be borne by the consumer. The second objective that they're trying to achieve is that companies will be enticed to bring manufacturing back to the U.S. to avoid tariff costs. That's kind of the thinking of this. And then if you look at this is a chart showing the contribution of different economic activities from Canada to the U.S. So oil and gas extraction makes up about 60% of Canadian exports to the U.S. And then you have, metal manufacturing, food manufacturing, wood, so a lot of this is resources, lumber, mining, petroleum, paper, and pulp, a byproduct of lumber and trees, right? So that's essentially how it breaks down. But of course, this round of tariffs is specifically focused on steel and aluminum, doesn't touch energy. So Alberta kind of gets a pass from at least for the time being. So how is this impacting U.S. trade partners? Well, it's not a universal, it's not a direct tariff to Canada. It's not explicitly for Canadian companies, but it sort of is, right? And this shows why. If you add up steel and aluminum imports to the U.S. and you look at where it's coming from, the vast majority is coming from Canada. And ironically, those top three suppliers to the U.S. are three of its best allies around the world. So there's a lot of questions about what this is going to do to U.S. trade relations, geopolitics, whether it's a negotiating tactic. There's just like who knows? Who knows right now? It remains to be seen. That's kind of beyond our scope. What we are trying to answer here is where in Canada is this going to have an impact? So this is an analysis that we did on our research team looking at something called location quotients. So location quotients are essentially a comparison of you take a certain industry in one city and you look at the ratio of employment in that industry and you compare it to the ratio nationally. So I'll use an example of Windsor. In Windsor, you have I think it's 20% or 19% of Windsor employment is in manufacturing. Nationally, that ratio is about 9%. 9% of Canadian employment is in manufacturing. So a location quotient is basically local divided by national, numerator over denominator. So 19 divided by 9 is 2.09. That's the location quotient for Windsor. That's a little bit of urban economics 101. The important takeaway here is that Southwestern Ontario cities have the highest exposure to manufacturing in Canada. I think this is kind of a lot of people sort of understand this. They sort of had a hunch. It makes sense. This is the automotive belt. It's the manufacturing belt, the link between Detroit and Toronto. So these towns, Windsor, Brantford, K-Dub, London especially, that's where you might see the biggest hit to employment if this is a sustained policy. On the other end of the spectrum, Ottawa is the most insulated, Halifax, pretty insulated, and then some prairie markets. But I would add to this that if we do see at some point tariffs on energy, then you're going to see an impact on Calgary, Edmonton, especially if you see tariffs on food, that would impact Halifax, that would impact Regina, Saskatoon. So that's sort of how it shakes out. And then, but this is just kind of cities, how it would impact, medium and large cities. This map here shows kind of more broadly how it would impact other areas of the country. So the brighter the yellow, the bigger the job impact. You see kind of northern BC, northern Alberta, northern Quebec. There was an article in the Globe about small towns in northern Quebec where there's a lot of aluminum production, right? So these small towns have the most to lose by this. Like even in a city like K-Dub or in an area like K-Dub, it's still a pretty diversified economy. There's universities, there's a lot of talent, there's a lot of education, there's different industries, it's diversified. But once you go into some of these northern towns, that's where you have, a whole town that revolves around one, plant that does this or does that. And those areas are the most exposed if this is a prolonged policy. So that's important to keep in mind. I want to ask Mitch something that I've been actually very eager to ask you over the last few weeks, and I'm going to do it here in a public forum. So the thinking behind this policy is to redirect investment, redirect manufacturing into the U.S. You work a lot with a lot of these manufacturing companies in Southwestern Ontario. What are they thinking? Is that realistic? What would they need to see? And what would impact that calculation for them to just uproot a factory in Brantford and move it to Detroit?
I think what a lot of organizations, in particular around manufacturing, have been doing over the last couple of weeks is just contingency planning, scenario planning. I've heard the term war room a lot lately. We're not seeing a lot of decisions be made at this point. When you really dig in, at least with our clients, and ask, what is the real impact here, right? Do you uproot a manufacturing operation? Massive cost to do it, massive investment for something that's unknown. At this point, we have not seen anything meaningful. I would say there is a level of gravity that seems to be existing when it comes to certain multinational or American-based companies. If they do have some redundant facilities, that likely would have been scrutinized earlier than the tariff situation. I think it's calling to light some of these older, redundant, operationally inferior facilities that probably should have been looked at a while ago. And so I think that may have some consequence of, consolidation. We saw a lot of consolidation through 0809. It was a different trajectory on where the operations and investments were going. It was going more overseas. Obviously, right now, it's more of a pull towards the US. But it's been interesting in the last, especially week, as time has settled, and maybe a little bit of PTSD from the COVID days. There's this shock factor that kicks in at the onset where everyone freezes, plans every scenario. But as you start really getting into the logistics of executing on, the idea of relocating operations, and you start realizing that there is a domestic element to all this in Canada. We've actually seen some recent groups look at opening new operations in Canada because that's where the goods may go. But again, far too early to say anyone has been acting on it. I would just say that if there were some weak spots before in the way of operational efficiencies, that stuff is being observed and likely being acted on, but haven't seen anything to suggest anybody's uprooting out of Canada completely at this point. And I would also just say that, the small businesses that are very regional based seem to be performing very well. Obviously, we get increase in unemployment, consumer, discretionary spending tightens up, call it a recession. That has impacts across all segments, but we have seen some really good resilience in a lot of ways. At this point, there is a lot of nerves out there. There is a lot of planning going on, but no one's ready to pull the trigger at this point.
Thanks, Mitch. I would also just add on that. I saw an interview with a guy who has a tool manufacturing business in Windsor, and what he was saying is that it's one thing where the final demand is, another thing is where is the workforce, and in some of these industries, it's such a specialized skill set and knowledge that you refine over years. And if you have a manufacturing plant that does a certain activity, you've had workers there for years that do something very specialized. It's not easy to, you can build a factory somewhere else, but then finding the talent and grooming that talent. I mean, the labor component to this, I think, gets lost in it. Like, it's not just about building factories here or there. It's finding and grooming a workforce that does something over years. So.
And Scott, if I can just jump in on something to that point, I think 0809 was not just a deleveraging in the financial system, but manufacturing in particular took a big hit in 0809. A lot of that traditional manufacturing did go overseas, and so I think we're dealing with a different level of inventory or exposure. Yeah, there's a level of jobs that could be impacted, right, but we did purge a lot of it. Give or take 15 years ago, that just didn't really leave us with a whole bunch of mass production manufacturing facilities necessarily. Most, if you look in a region like Waterloo Region, Guelph, even Brantford with food, these are advanced manufacturing facilities. These are not your 1950s, mass produced, trying to just compete on scale and cost. Canada really kind of purged a lot of that out of the last 0809 cycle.
Thanks, Mitch. Good to know. So now we're going to get into real estate markets and what we've seen over the last year and what we're expecting to see over the next year. So I'm going to start with just where we are on interest rates. So we hear all the time about how interest rates are falling. And when we hear that in the news, we're hearing mostly about this purple line, the overnight lending rate, the policy, the benchmark policy rate from the Bank of Canada. But when we talk about real estate investment, acquisitions, dispositions, mortgages, term lending, that's all based on these bond yields, right? And so bond yields actually hit a low in, call it, September, October of last year. But they haven't really moved in tandem with the policy rate since. And actually, in January, I should probably update this because every time I update this chart, the bond yields just move in a completely different way. It's kind of annoying. But there was a spike in bond yields in January. And so it's not, when people talk about how interest rates are falling, it's more complex than the Bank of Canada rate. If you're looking at taking on a mortgage to acquire a $100 million asset, you're looking at these bond yields and you might be saying, well, the cost of capital is higher than it was a few months ago. So I want to bring our head of capital markets on here, Matt. So you work with institutional investors, a lot of diversified investors who are benchmarking against bond yields. What are they saying? What's their outlook? Are they optimistic, pessimistic? What are they saying?
Good morning. They're not saying a lot right now, if I'm being completely honest. I think Canadian institutions are, for the most part, sitting back and waiting for a lot of the noise to settle down. And there's a lot of noise, as Scott mentioned at the very beginning of the call, whether it's Mr. Navarro's interview yesterday with the New York Times, the podcast, or Trump tweeting or Xing, whatever you call it as a verb. A lot of our institutional investors are just pens down. I was with the head of real estate for one of Canada's most active pension funds yesterday, and they are essentially reserving all capital deployment to the U.S., which was a big focus for many Canadian institutions over the last couple of years. They were actually recycling capital out of Canada and redeploying to the U.S. But right now, just given the uncertainty in between Canada and U.S., and you can look at the bond market really in Canada as a bit of a proxy to that uncertainty. It has been extremely volatile. What we really need is a sustained period of leveling off within the bond markets. And same goes with treasury yields in the US. Because we've had this choppiness, any group, whether it's an institution or a private investor who looks to put some real estate under contract, by the time it goes firm or by the time they close, they might see a situation in which borrowing costs have increased 40 or 50 basis points, or maybe they've come in. We have actually seen that level of volatility in with the bond markets over the last several months. So that is a main driver, I would say, but it also does reflect the broader uncertainty that we're all facing right now.
Thanks, Matt. So what's happening in bond markets? What's happening in interest rates? I think you see it reflected in overall commercial real estate investment volume. So we've seen a 14% drop year over year. Our final tally, and this is we track everything over $5 million and over. We're not tracking all trades. All the small stuff. We're just doing 5 million over. We get about 48 billion, 49 billion across Canada, split amongst these asset classes. Down 14% year over year, down 25% versus 2022. But worth keeping in mind that it's not that bad. Like, this is kind of where the market was at in the late 2010s, right? And if you think about where bond yields are at and where interest rates are at, that makes sense. They were sort of in the same ballpark in these years, right? And then looking at it by sector, you see kind of the breakout. Toronto, obviously, 15 billion, the biggest market. Southwestern Ontario, 4.2 billion. Actually, a lot of momentum there over the last few years, and it is when you add in a lot of the cities surrounding KW, whether it's Guelph, London, Hamilton, it's the fourth biggest investment market in Canada. Not many people realize that. Bigger than Calgary, Edmonton, and Ottawa when you include that radius. So, Matt, I wanted to ask you, how are institutional investors looking at Southwestern Ontario right now? There's been a lot of demographic momentum. We're seeing a lot more sale volume there over the last few years. What are you hearing about that market?
I'll try to condense a short question, but potentially a long-winded answer. I would say the general theme with Canadian institutions right now, as I said earlier, is they are looking to lower their allocation to Canadian real estate and looking to redeploy into other jurisdictions, EMEA and the US. But caveat on the U.S. is obviously with everything that's going on right now, that is for the most part on hold. Many of these Canadian institutions who in the past were teaming up with sponsors, teaming up with developers to build new industrial in southwestern Ontario or possibly purpose-built rental, those may be long-term holds, or they could be sales, realizing that the market has reached a bit of a fever pitch. I think if anything, we're on the downswing when you consider cap rate decompression. Generally, institutions in Canada are definitely shifting or pivoting away from buying existing income producing and looking more of a ground up development strategy. Again, whether that's in industrial ground up or in purpose built rental or even purpose built student accommodation, PBSA, which is becoming, it's a bit of a nascent sector, but it's becoming more commonplace. I would say generally the southwestern Ontario market really has enjoyed its day in the sun. Lots of activity, lots of leasing velocity. Unfortunately, and I don't want Mitch to yell at me after this, it's no Brampton, it's no Mississauga. So when you consider industrial, that would be center ice, to use a hockey analogy, and I would say southwestern Ontario would be a little bit closer to the blue line. Maybe not the blue line, but closer to the blue line. So with that as a backdrop, I think some Canadian institutions might be keen to maybe loosen or reduce their exposure to some of these perceived, and with air quotes, secondary markets. That said, as I said earlier, a lot of these institutions have a build-to-core strategy, and they may be looking to hold over the long term.
Thanks, Matt. So the next chart looks at, so this is kind of why Matt alluded to institutional investors for the most part on hold, and this is why the gap, back in the 2010s, there was a wide gap between the 10-year yield, kind of a benchmark for cost of capital, and cap rates. On a typical industrial deal, you were getting, call it 375 basis point of spread, of premium, of profit in between your bond yield and your cap rate. You fast forward today, and that premium for taking on that risk, that operational cost of owning real estate, has really shrunk. So in the industrial market, again, we'll pick on Mitch, a spread of around 260 basis points compared to, historically 375. This is why, but again, this is just on the topic of institutional investors. Further in the presentation, we're going to see why private investors and users are filling that gap. So to Matt's point, a lot of institutions are selling right now, or they're on pause. This is why. And then just looking at kind of different sectors and how kind of what the bidding process is looking like. This is proprietary data that we have within our systems that on a global basis, we're tracking all of our transactions, all of whoever's bidding, what the bid is relative to the asking price, relative to the final sale price. And basically what this is showing, these black lines here are the average closing price relative to asking price. And so you see in the industrial market, this is global data. We've really kind of hit an inflection point where on industrial, on multifamily, and on retail, the average closing price is actually north of asking. In the office market, sorry, Chris, to pick on the office market, but we're still not quite there. We're seeing, again, on a global level, around a 5% discount relative to asking where the closing bid falls. The other interesting thing that this data tells us, you look at kind of how wide these bars are in office and in retail, that means that there's a bigger gap. There's a broader spectrum of where the bids are coming in. So there's still a lot of questions about valuations, and what the proper value is. Whereas in industrial multifamily, you see a tighter spread, a tighter range of bids. That just means that there's more certainty on industrial multifamily about what value is. Certainly, there's still a lot of debates about that between buyers and sellers, but less so than office and retail. So, these are some takeaways. We'll leave this when we send this out. I'm not going to take the time to go through this because we do have to keep moving. But I want to get into some specific market fundamentals here. I'm going to start with the office market. And Chris, I'm going to put you on the hot seat here, so get ready. So this is looking nationally at supply, demand, and vacancy. The light blue is new supply, new buildings that are completed, delivered to market. The dark blue is net absorption. That's our demand metric here. And this net absorption, not to be confused with gross leasing, which I'm also going to show. Net absorption takes into account downsizing and upsizing. So it's kind of the net difference between, think of it as the difference between the move-ins minus the move-outs. Okay, and so what we saw over the last 5 years, we've had negative absorption nationally in each of the last 5 years. The good news is, if you look at where we landed in 2024, we're at about negative 690,000 square feet. Sounds bad because it's negative. It's actually the best year that Canada's had since 2019. And it's looking like we might be hitting an inflection point over the next year. Why? Because if you look at these forecasts of new supply, we're going to be falling close to zero. So that means that by 2028, there's going to be almost no new office buildings under construction across Canada. Okay, maybe one or two. What that's going to do is it's going to give demand time to recover, right? So you have a certain amount of leasing that happens. It's going to have to be concentrated in like relatively fewer buildings, right? So that's going to be better for vacancy. We might see vacancy peak in 2025. I don't want to put myself too far out there, but there's a possibility it could happen next year, and if not, definitely the year after. We're expecting it to happen soon. This next chart is looking at gross leasing. So this is different from net absorption. This is the sum of new leases, subleases, renewals, basically all leasing activity. And the last quarter of 2024 was the best quarter since 2022, the best quarter in 2 years for overall leasing across Canada. So we're starting to see some actual real data-driven positive signals in the office market. And then, so Chris, I want to just ask you real quick, like, what are you seeing in leasing momentum? Does this jive with what you're seeing locally? What's your thoughts?
Yeah, it definitely does, Scott. I like you don't want to put myself out there, and I may get some interesting emails after I say this, but I actually think 2025 could be the best year post-COVID that we've seen in the KW market, Region of Waterloo, Southwestern Ontario, for leasing volume specifically. So placing a bit of a bet there in what I'm saying, but tenant requirements are way up. Tour activity is gaining, I would say, an incredible amount of momentum. There's generally just more offers, paper proposals flying around right now, which is definitely encouraging. So I'm not trying to say everything's perfect. Just, as you said, I think there's a lot of caution in the office market. And certainly not suggesting anyone runs out and builds a new office building at this time, but there's definitely a shift happening and you can feel it. I think we're seeing a lot of companies start to enforce finally their return to work mandates. And overall, I think people are just ready to get back to normal. I mean, it took 5 years, but I think the feeling is there, and being around people and just things are a lot more productive when you're around your peers and your ability to actually do your work. So, like I said, I think it's going to be a very strong year for leasing volumes in 2025.
Thanks, Chris. So this is a chart looking at in each city that we're tracking 9 Canadian markets, the last few years where net absorption has landed. And I drew these boxes because it's really, there's really a story to tell geographically about momentum in the office markets in Western versus Eastern Canada. You look at Western Canadian markets, you see pretty much across the board positive absorption. So that's net gains in occupancy in the office market. Okay, so Calgary at 1.3 million square feet of absorption. Calgary was the #1 city in North America in 2024 for net absorption. Vancouver was #2. So lots of momentum there. And again, a lot of it goes back to what we talked about earlier, demographics. Calgary leads Canada in interprovincial immigration. Calgary is very bullish on in-office culture. it's it's a compelling market right now, and we're seeing those demographics translate into a lot of momentum. Edmonton, the same, to a lesser extent than Calgary. Winnipeg, they had a large Wawanesa consolidation downtown, brand new trophy office building that was the primary driver for that. And then Southwestern Ontario, kind of in the middle, positive absorption. It's more of a stable market. Where we've seen a lot of the negative absorption is Toronto, Ottawa, Montreal. Why? Because to put it short, these cities have hybrid and remote work are a lot more entrenched. We're seeing in these three cities, but also in Toronto, especially, we've had so much new supply that's helped to drive up vacancy. And a lot of that is happening when you have certain buildings that have been completed with large blocks of vacancy. Once that building hits the market, that hits our absorption figures. And that's why in Toronto, despite Toronto actually had a really good year for leasing, but because we have a few brand new buildings that were delivered essentially empty, we have negative 1.4 million square feet of net absorption. Next chart I'm going to show is this is a breakdown that we do looking at within a certain market. Where's the momentum in terms of, is it downtown, is it suburban, or is it what we call urban submarkets? So for those of you who know Toronto well, an urban market would be like Yonge and Egg, Yonge and St. Clair, right? Not quite downtown, not quite suburban. In KW, the urban market for us is Uptown Waterloo, right? It's not downtown Kitchener is sort of like the downtown for the region. Uptown is not that, but it's also not suburban. So this is just showing, from west to east, downtown Vancouver, downtown Calgary, a lot of momentum there. It's also showing where the sort of where the lag is. Downtown Toronto, downtown Montreal. Southwestern Ontario, where's the momentum right now? It's in the suburbs. A lot of positive absorption there in the suburbs. Negative absorption downtown. Chris, does this jive with what you're seeing?
100%. There's not much more I can add to that, Scott. Honestly, definitely suburban Waterloo, no question. It's the part of the market that offers really reasonably priced, high quality real estate. Really well serviced by transit, lots of amenities, close proximity to post-secondary, universities, things like that, which a lot of tenants seek. And then, of course, the big one around here is free parking. That's a huge driver, and all of that sort of landscape, the suburban Waterloo market provides that. And that's not a new thing for our market, by the way, for the suburban Waterloo market to outperform others. It's pretty consistent with history.
Yeah. There's certain cities like Edmonton, we see this a lot, where a lot of tenants show a preference for suburbs, for parking ratios, things like that. This is sort of a new, a few years ago, this chart would have looked very different, but we're now seeing office vacancy higher across the board. Every Canadian market, office vacancies higher downtown than in the suburbs. So Vancouver, Toronto, especially, and Montreal and Ottawa, those four markets in particular, downtown vacancy for a long time was extremely low. We're starting to see that change. And then just a few more things on the office market. We're seeing, so we get a lot of questions about, what's the sort of space utilization strategy? How's that looking? This is from we do this survey of all of our corporate occupier accounts every year. It's like, I think it's like 200, 250 accounts that we're surveying on their approach to hybrid work and remote work. And there's a few things that stand out to me here. The first is that you see fully in, so this is 2 years ago, fully in office, 2% of our accounts were fully in. Now we're seeing close to 20%. So a lot more companies are fully invested in bringing their workers back. You also see this fully remote, 14% 2 years ago, 14% of our corporate accounts of our occupier clients were fully remote. Now that's just 1%. Hybrid, 70%, and now 75% in 2024. So the big shifts, I would summarize it as remote is going away. It's becoming increasingly less common. Hybrid is becoming more common and more entrenched. And there's a lot of momentum for bringing people back fully in office, to a lesser extent than hybrid. But I tell this to landlord clients a lot. It's, we're getting away from hybrid, or I'm sorry, we're getting away from remote, but we're sort of in a hybrid market right now, and that's I think that's a reality that's dawned on everyone in the office market. And then the last thing on the office market, and then I'm going to put Mitch on the spot here. The biggest shift we've been seeing is the change in buyer. So this is office investment sales across Canada. We actually had, this is a positive story, 2024, 4.5 billion versus 3.6 last year. So a lot more in office investment sales this past year. We're starting to come to a little bit more of a consensus on how to price it. We're still a long ways off from where we were pre-COVID, but we're improving. The biggest shift that's happened, in my view, is, you see this purple, which is private investors. Half of the market, and last year it was around 70% of the market, is private investors. About 20% of the market is user acquisitions. So Chris, I know you work with, I know KW is a very active market in terms of user investors. How are users looking at the current landscape? And definitely, like, with everything going on with immigration and tariffs and all the craziness, like, do you see this story continuing in 2025?
Yeah, I do. Like, historically speaking, this market has always had a very healthy level of owner user real estate as it relates to office, industrial too, but talking about office specifically, I see it continuing. I think that momentum hasn't really shifted, changed sort of over the last 5 years. We saw a huge run up of owner occupier purchases really coming out of COVID when the interest rate climate was really low. And we really expected that sort of appetite might dry up a bit, but it hasn't. And I would say the biggest challenge, again, if you can believe this, is actually finding availability of buildings that you can buy as a user that has enough vacancy for you to occupy. So a lot of the low-lying fruit of what would have been really good candidates, you saw a lot of those buildings trade coming out of COVID, 21, 22, even into 23. Now, there's very little on the market. You have to get really creative. So on the go forward, I think that will absolutely be there as part of our market. It's just getting tougher and tougher to actually find the right fit depending on who the buyer is.
Yeah. Thanks, Chris. And so the last part of our presentation, I think we'll give it about 10 minutes on this, and then we'll open it up for Q&A. And then Mitch, I'm going to put you on the hot seat here. So industrial, this is just looking at industrial fundamentals. The dark blue is net absorption. So again, move-ins minus move-outs. The light blue is new completions, new deliveries to market. So there's sort of different eras over the last decade. You had kind of this 2017, 2018 period where you had demand way ahead of supply, and so vacancy fell quite a bit. And then you had COVID, which was its own kind of weird time. 2021, 2022, we had just an insane amount of industrial demand, companies basically trying to redo their supply chain. And I heard the phrase 10 years of demand in 1 year, packed into 1 year. Industrial vacancy goes down to about 1.5%. The last year or 2 years have really been kind of a shift in the pendulum. Developers responding to demand, building product, just as the demand kind of slows a little bit, and now we're at almost pushing our highest industrial vacancy rate in the last 10 years. Mitch, what's your assessment for where are you seeing things going forward for 2025?
Yeah, I would just really caution reading the tea leaves in the index, meaning, overall vacancies up to a more normalized historical level, right? 4.5%, 5%. When you look at the makeup of that, and this is not a Southwestern Ontario trend, this is Canadian, this is US, this is globally. The bulk of that new supply that came on, you can see those light blue bars there through 23. Most of those were larger box industrial spaces. And no doubt there is an important need for those types of facilities. We actually see an incredibly tight vacancy level, in particular in Southwest Ontario, in sizes under 50,000 square feet, where nothing was being developed during the boom times. And so I think, unlike office, which has a longer period to build an office building, right, call it 3 to 4 years, industrial completions seem to be coming to kind of full fruition at this point. But I would just caution reading only the index, because a lot of the vacancy is really made up of larger spaces. The small stuff seems to be really performing well still, and no real oversupply issues.
A lot of that vacancy concentrated in large bay. We're seeing that pretty much across the board. And then, so that construction pipeline peaked 2023. We had over 50 million square feet under construction across Canada, way above the historical average. But you can see we're sort of working our way through that. And I suspect that by the end of this year, that number is going to be way back down to, normal levels. In terms of where we're seeing demand, this is annual net absorption across Canada by market. So you see Vancouver, Toronto, and Montreal, a lot of that negative absorption concentrated there. But this isn't, I want to just clarify something. This doesn't mean that users are downsizing in mass. That's not really what's happening here. When we see negative absorption in the industrial market, really what that is a lot of new buildings being completed, delivered to market with large blocks of vacancy. And so once that vacancy becomes, we call it operational for a tenant to come in and use, but it's empty, that's a one-time hit to our absorption figures. So that's why we see negative absorption in Toronto, Montreal, such a low number. It's just because there was so much new product brought to market with large blocks of availability. But then Calgary and Edmonton, Winnipeg, Southwest Ontario, a lot of these kind of smaller markets than Toronto, Vancouver, and Montreal, you see more stable demand. That's because you didn't have such a massive kind of glut of new supply hitting the market at once that translated into negative absorption.
John, I would just add one more point to that. We've definitely seen in the last 6 months in particular, end of 24, it's called a recession playbook from industrial tenants seeking value in neighboring or nearby markets, right? I mean, if you look at the performance in Calgary, a lot of that is driven by tenants that may have gone at one point to Vancouver, but are looking for more value, if you will, on higher quality facilities. No doubt, Brantford, as an example, in Southwest Ontario, saw some incredible absorption in 2024 in Q4, largely because, as tenants reevaluate their space needs, they may look to generally, right size their footprint. Sometimes that is downsizing, but they're also saying, I may go from an $18 or $20 net rent in Toronto, and if I have the ability to go to a Brantford and pay $11 or $12, that's a compelling financial reason to evaluate it. So it's an interesting situation that we're seeing play out, where these tenants are seeking value depending upon who they are, where they're distributing, what they're manufacturing for. It'll be interesting to see how it plays out over the course of the next 6 to 12 months here.
Yeah, agreed. And then just what's happened with vacancy, again, in large part due to a lot of new completions hitting the market. You see Vancouver going from 0.6% up to 3.6% in a few years. Southwestern Ontario, 0.5%, I believe, up to 4.8%. Toronto, Ottawa, Montreal, you see a sharp uptick in vacancy, which I would add is, I would call this a normalization. Like 4 or 5% vacancy is not anything to freak out about. I mean, if you look at south of the border markets like Dallas, Chicago, some of the more oversupplied U.S. markets, you're probably talking about 10 to 12% vacancy. So again, we have to keep things in perspective. For Canada, industrial, these are high vacancy rates. Globally, these are still, very normal. It's very normal what's happening. Matt, I have a question for you. So this is a chart looking at rents across the board in Canada, and you see rental growth turning negative, and Vancouver, Toronto kind of peaking at $19 and falling, Montreal peaking at $16 and coming down from there. These years where rents were peaking, that's when industrial acquisitions were red hot. So I'm really curious how are investors thinking about rental growth in the industrial market? What kinds of assumptions are they using right now? Are they assuming negative rental growth for the next, few months, year? Like how's that underwriting looking?
Yeah, I think it really depends by market, Scott. We saw such a run up in industrial rents. I got in the business in the late 1990s. Yes, I'm that old. And I remember from essentially the late 90s until the mid 2010s, industrial rents in the greater Golden Horseshoe essentially stayed the same. In Mississauga, a brand new building would generate a rent of around $6.75, $7 a foot, and a second generation building would be kind of mid fours to low fives. And then we saw this huge run up, and I think a lot of it had to do with the fact that construction costs just continued to escalate, and we had seen such nominal growth over the years. Regardless, as advisors, when we're selling large industrial portfolios or single industrial investment properties, we still need to show rental growth, and we would show them in our pro formas. But then, as opposed from 2.5%, we popped to 3, and then 4, and then 5, and we got to a point where it was 10% year over year. We literally saw rents go in Toronto area, the GTAH, from, like I said, that kind of $6.50 to $7 a foot up to $20 or even higher in some cases. I think what we're starting to see now is a cool off. We're seeing a cool off because of the new supply, because of the tepid demand, not tepid, but I would say a softening in demand. And we need to wait until a lot of these big boxes are filled up. There's a lot of land out there as well that investors have purchased, and to justify the numbers that they paid for it, they're going to need to hit these numbers. And unfortunately, I think a lot of those sites will remain undeveloped for some time. But to answer your question, Scott, we are definitely seeing a softening. No longer are we seeing the crazy year-over-year rent growth. I do think it depends on the product type, though. Smaller bay, we continue to see more aggressive underwriting just because it's too costly to build that product, even more so than big box, high bay industrial. So we'll see probably a little bit more aggressive underwriting there. But yes, we're seeing a cool off. We're reverting back to not 0% for the first couple of years. I would say 2.5% is more likely the norm today.
Thanks, Matt. So we're coming up on time, and I just want to say if anyone has questions, feel free to drop them in the chat. I have maybe 1 or 2 more slides to get through, and then we can kind of open up to some of the audience questions. This is basically the same thing, looking at a different view of rental growth. But I want to take a look at investment sales. We see 11.5 billion in 2024 industrial investment sales across Canada, down from 18.4 billion the year before. Similar to the office market, dominated by private investors. Still, 60% of liquidity this past year was private investors, but then 19% were user purchases. I guess Mitch and Matt, we can have a panel here. When you guys are looking at industrial sales, what's behind this? Why are users the fastest growing cohort of buyers in the industrial market?
Can I maybe just jump on that one? Because the math, I think, doesn't lie. We've completed a lot, and I know, Chris, you've been doing it on the office side of lease versus own analysis. And when you look at, the cost of debt, you look at vehicles and lenders like Business Development Bank of Canada, who may offer higher loan to value, right? It's somewhat, subsidized debt in a way to fuel investment into industry in Ontario and in Canada. Where I'm going with all that is over the course of a 10-year hold without any appreciation, assuming interest rates may come down even slightly, the benefit in owning exceeds that in leasing. In fact, what we found is market lease rates for industrial are about the same monthly or annual cost to service as a mortgage would be for market pricing on interest rates at around 5%. And so, hey, if the cost to own is the same as the cost to lease on a cash flow basis, plus you don't have to put up a lot of your working capital because a BDC will finance 90-100% financing, it's a compelling mathematical argument to evaluate owning your facilities. Where I think the leasing comes in, though, is especially in these fluid demand times. It's hard for buyers to say, I know what the next 10 years looks like. And so we do see some real activity in leasing over the short term as companies evaluate kind of what their long-term space needs are, similar what you saw in office in COVID. And I think when you look at a segment of the industrial market and tenants, which is third-party logistics companies, may have a very nice run. A lot of the transaction activity in Q4 and leasing was to third-party logistics companies because the end users themselves are trying to remain fluid with their space commitments as they work through and really get some visibility on this tariff situation.
My only other comment, I agree with Mitch wholeheartedly. My only other comment is that the last few years have been a little bit topsy-turvy as far as capital markets is concerned and capital deployment from investors, whether they're institutions or private family office. We are seeing a lot of groups sitting on the sidelines, especially the institutions, as their capital allocation has been in flux. So as a result of that, you're not seeing the frenzy of bidding. We would routinely see situations in which we'd be getting double-digit number of bids on a first round, whether it's for an industrial building or an office. And with that now kind of closer to low single digits, I think occupiers or owner-occupiers, users feel there's a great opportunity for them to step up into a horse race in which there are fewer horses. And I think, as we all know, the less tension there is, probably the superior pricing they're able to get. That doesn't always end up being the case. In some cases, we have seen occupiers or users that have paid way more than what an institutional investor would pay. But I think it's a perception that there's less competition.
Yeah, thanks, guys. So, and then I'm just going to conclude with this. This is looking at investment volumes in the industrial sector by market. You obviously see Toronto as the biggest market for industrial investment sales. You do see a fall off year over year across the board. But Matt, I want to ask you, 2025, where do you see, do you think we're going to see an uptick in industrial sales? Do you think we're going to continue to see some pause? What's your outlook?
Well, I can tell you over the holidays, I felt pretty good going into 2025, but the last few weeks I felt a little bit more down. We had a saying, survive until 25, and that was really an old adage from survive until 95. For those of you on this call, if you remember what that was like, certainly different time today. I will say this, if you look at the U.S. as a proxy, and notwithstanding some of the political turmoil, the FOMO is real. FOMO, fear of missing out. And we are seeing a massive uptick in campaigns, so offerings, opportunities, bid activity, pricing is going up. And I think a lot of U.S. investors anyway are kind of chasing each other, and they want to be at the front of the queue. In Canada, we did start to see that a little bit in the third and fourth quarter of 24. Again, that survive until 25 expression that people felt reasonably good going into this year. I'm going to take a step back a little bit, not to curb your enthusiasm or my own enthusiasm. I do think that we are going to see a resurgence, but I think it will happen toward the back half of 2025. I think we lead a lot of this noise, as I said at the beginning of this of this session. I think we need a lot of the noise just to kind of cool down a little bit. We need to see what the Trump administration is going to do with respect to tariffs in the next 15 days after the 30-day cool off. We need to see with the impact of steel, aluminum tariffs, and really kind of some of the broader geopolitical turmoil as well. The world is somewhat on edge right now, and I think Canadian investors are similarly. They were waiting to pounce, but now they're taking a step back. The good news is though that NOI, net operating income, leasing velocity across every asset class is up. So industrial, office, retail, maybe multifamily might be down a little bit, but those three of the four food groups were seeing an improvement, and that's going to help to I think pull investors back, that they see light at the end of the tunnel as opposed to it being very dire and negative. So that would be my prediction, but don't hold me to it.
Don't worry, we will. Thanks, Matt. And so we're at about time. And before I turn it back over to Mitch to say goodbye to everyone, I think it's really important what Matt just said. And we're releasing our 2025 Outlook report this week, I think tomorrow. And that's one of the main points is like there's all this crazy stuff happening. But if you just look at fundamentals, like they're improving in pretty much every sector. Office, industrial, retail. We're seeing leasing improving over the last few months or the last year. Retail has been performing extremely well. There's a lot of positivity out there when you just look at the market and tune out the noise. So that's kind of the message I'm going to end on. And Mitch, I'll turn it back over to you.
Yeah, I want to take a moment to thank everybody, our speakers, Matt, Scott, Chris. Appreciate your insights and sharing what you're seeing out there. Like Scott said, the market continues to evolve, and we think these discussions and regular touch points are important as ever. And whether it's lease rates, macro impacts, we think more data helps sculpt the real story instead of just fear and operating out of pure fear. And so our team is here to support. If ever anyone has needs looking for intelligence, we're here to support you as our customers. And we'd like to take a minute to thank all of you for jumping on the call. A copy of the deck, it's a heck of a lot longer than the slides we looked at, will be circulated to also address some of the elements around multifamily and retail. And a copy of the recording of this will be circulated as well. So can be watched for anybody who wasn't able to join. Again, on behalf of our entire JLL team, we do appreciate everyone's time and engagement today. We appreciate all of your participation and your partnership. Just like to say have a great day and look forward to reconnecting with everybody real soon. Take care.